You're listening to the Political Book Show podcast.
Economic orthodoxy says globalization is the best route to prosperity. Yet across the Western world, popular opinion is more and more rejecting its credo. Stephen d.king's book, Grave New World, is an analysis of why that's happening and ultimately a defence of globalization. I'm joined by Stephen d.king, who's the author of Grave New World. Thanks for joining me, Stephen.
It's a pleasure. Nice to be with you.
Your book, in essence, it's about globalisation, very hot topic at the moment. Really, really detailed. I just want to say, first of all, congratulations on, you really went into the history, and the history from different countries' perspective. And, it was a really, really broad book, really, really good. Explain what you mean by globalisation.
Well, first of all, thank you for those kind comments. That's very nice of you. Well, I guess globalization means lots of different things to different people. But so for me, globalization is very much a story about barriers and borders dissolving, coming down over time, so that you get the free exchange, the free movement of goods and services and people and capital, actually all of which is encapsulated in the four freedoms of the European Union. But I suppose in that sense, globalization is in a sense, a contradiction to the existence of nation states, that nation states get in the way of that freedom of exchange, and globalization, by reducing those borders, makes these things much easier to take place. And certainly over the last 60 or 70 years, it's been associated with, obviously, the growth of international capital markets, much stronger world trade growth, and also, I suppose, the idea that particularly Western values could potentially be universal values. Particularly this is true, I think, after the fall of the Berlin Wall in 1989, when there was a strong sense that what was good for the West could indeed also be good for the rest too.
You touched on in your book, obviously with Brexit, the Brexit vote being quite in our recent memory. Do you think the future of the euro is in doubt? Are Germans prepared to transfer wealth to poor parts of Europe? So, under a single currency, as you talked about, what's to stop German banks lending, say, to Italians without the risk of the lira devaluing if the debt goes bad?
Well, this is a huge problem, and it's been a problem really since the euro was first created. And a way to sort of think about this, I think, in reverse almost, is to say, well, imagine that the US was more like the Eurozone. Imagine that the federal authorities in Washington, D.C. were largely abolished, and you're simply left with the Federal Reserve as the issuer of a sole single currency for the 50 independent nation states that formerly were the US. And imagine that the people of Massachusetts suddenly discovered that they've been paying their tax dollars to support the people of Mississippi. Now, my guess is that if Massachusetts was a newly formed independent nation state, it would no longer want to offer that kind of generosity to the people of Mississippi. And in one sense, Germany is the equivalent of Massachusetts, and countries in Southern Europe are rather the equivalent of Mississippi.
The thing, sorry to jump in, but the thing about the American states is obviously they do have a shared identity, they have a shared language. Is the mentality not different with Europe? Is the European zone, are they as prepared to muck in and help the poorer regions along?
Well, I think it's difficult. And the reason why I was giving the example was precisely because what is imaginable and doable in the US, because they have got this kind of common identity, is much more difficult to do in the case of Europe, where the role of the nation state is in many ways much more significant than would be the case for the role of the individual states in the US. Although, of course, it is worth noting that if you're going back to, say, the 1860s, you might have a very different view of the US in the midst of the Civil War.
True.
So things haven't been quite smooth sailing all the way through for the US, but nevertheless, it is true today that people have a common American identity in the way that people don't have a common European identity.
To demonstrate creditworthiness, okay, so countries tighten belt after a crash, but prolonged austerity, it leads to economic contraction. So in a globalised world, is that contraction contagious? Do you think the world entering a Japanese-style low inflationary malaise at the moment?
Well, actually, I think it already has entered this kind of period. If you look at certainly the experience of the US, the UK, many parts of the Eurozone, they've had experiences over the last 10 years which are remarkably similar, actually, to the experiences of Japan, which started in its first lost decade in the 1990s. And this is a story about high levels of debt, a story about very low rates of economic growth compared to what we've seen in the past, particularly weak productivity performance, so output per hour or output per head is not rising particularly quickly, which is surprising given the technological advances we see around us.
Is the Japanese story
this is a big problem, of course.
Is the demographics of Japan, is that a big factor in their economic slowdown? Because, obviously in the 80s it was Sony, it was Toyota, it seemed to be the great new Asian power, but then China came along. It's kind of moved towards that direction. So, is it purely because of it, the deflation in Japan? Is that purely the reason why it's experienced such slow growth, or is there other factors?
No, there are other factors too. I mean, if you go back to 1990, when the kind of rot set in Japan, that was interestingly the year in which the so-called old age dependency ratio started to rise for the first time. In other words, that people in retirement were rising as a proportion of the total adult population. And of course, that story has continued ever since. And you're absolutely right about the role of China, that companies in Japan or elsewhere that might previously have invested in Japan have instead chosen to invest in China, where, of course, labour costs are significantly lower. But I think what is striking about this is that this is no longer a story that applies purely to Japan. The demographic story applies to a certain degree, not quite as much, but to a certain degree in many parts of the Western world. So Germany, for example, Italy, are both experiencing the same kind of population aging now that Japan went through in the 1990s. And of course, as international capitals become ever more mobile, then even the West has succumbed to the same kind of issue of investment that might previously have taken place in the States or in Europe, having gone to other parts of the world where labour costs are significantly lower. So some of those Japanese flavours certainly have come through in the West in recent years.
On the subject of inflation, why do governments prioritise getting inflation levels correct over other things like employment or wealth distribution? Maybe that's not entirely fair to say, but it does seem that the central bank, their main priority is controlling inflation. Why is that?
Well, I think part of the issue here, oddly enough, is a historical issue, namely that the current generation of central bankers are of an age where their formative economic experiences were in the 1970s, when inflation was running amok. It was totally out of control. And there's certainly, I think, a strong sense amongst the central banking community they cannot possibly allow that sort of thing to happen again. The second issue, more recent, and this again relates to the Japanese experience, is that in the world of deflation, where interest rates can't fall any further and prices themselves are in danger of falling, then the real level of debt becomes an ever bigger burden. So if you owe someone money and the value of money effectively is falling, then the amount you owe them in real terms is going up and up each and every single year. So there's an issue of, if you've got high levels of debt in the first place and then you have deflation, then it's difficult to escape from that particular story. But I think also there is a sort of shifting narrative beginning to emerge now, particularly after the global financial crisis, where it was pretty clear before the crisis that although inflation for the most part was under pretty good control, nevertheless there were still significant signs of economic instability coming through, most obviously financial instability. And there are lots of people, including, for example, the Bank for International Settlements, which have said recently, look, price stability is one thing, but it's not the only thing we should be looking at. We should also be looking at financial stability too, because in the absence of financial stability, we'll still have boom and bust, even if inflation itself was under control. And actually go back a long way in history, go back over the last, say, 200 or 300 years, and look at, let's say, the experience of England and the number of recessions it's had. Many, many recessions, but very few of them are caused by inflation. So I think there's now a recognition that perhaps macroeconomic stability is not just about price stability alone. Yeah,
I know, obviously, everyone has this image of people with wheelbarrows of money, in Germany. I'm a child of the 80s, so I can vaguely remember, queues and stuff like that, and that kind of looms large. But do you think, On a kind of related question, is it worth putting up with slower growth overall if the wealth distribution is fairer? I think that's really at the heart of the kind of debate over globalization.
Well, it is. And here it's actually a rather awkward debate in one sense, because the increases in inequality, in income inequality and wealth inequality have a variety of different reasons, some of which are probably associated with globalization, but not all. So, for example, in the US, there's plenty of evidence to suggest that new technologies have created a kind of hollowing out of the workforce, that people who might happily have had clerical jobs and have enjoyed working in those areas for many, many years have suddenly discovered they've been replaced by computers and robots and so on. And many of those who've lost their jobs in those areas are forced to compete in areas which are basically lower paid and perhaps don't require such a high level of educational investment. And this creates a kind of trickle-down effect of downward pressure on wages throughout the workforce. It's got nothing to do with globalization at all, in fact, but nevertheless it's something which has emerged as a powerful theme over the course of the last 15 years or so. Then you also have in the West some evidence of educational shortfalls. So there are these things called the so-called PISA tests, which are standardized international tests for numeracy and literacy. And the idea is to sort of see how kids at the age of 15 perform on these tests around different parts of the world. So you can create these league tables. And what is striking there is that if you're in East Asia, so Japan, Taiwan, South Korea, parts of China, you score incredibly well on these tests. There's a tremendous emphasis on the importance of education in these countries. But whereas if you look at, say, the UK, or in particular, actually, the US, the ranking or the relative ranking on these tables has gone down a long way. And that's worrying in itself, because it suggests that there are certain educational failures which mean that perhaps people are not quite so well able to cope in an increasingly globalized and competitive world. So again, it's not directly associated with globalization, but it's something which has had an impact on the income and wealth distribution. And I think what is slightly worrying in some ways is that the debate about globalization and why it's a bad thing rather than a good thing is a debate that, in one sense, fails to recognize one particular aspect of globalization, which is that over the last 30 or 40 years, as more countries become integrated into the global economy, we have seen the most dramatic reductions in poverty. I'm thinking particularly here of China, and in particular also parts of India, and indeed in Asia in general. It's been a remarkable story of poverty reduction. The difficulty has been that at the same time as this poverty reduction has come through, in the Western world, I'm thinking here of Western Europe, North America, you've seen a big increase in income inequality. So there's a kind of paradox in one sense, which is that at the global level, inequality is narrowing, but at the local level in the West, it has actually increased.
Bernie Sanders would be someone who picked up that theme. He said global economy is not working. As you say, if you're a Chinese factory worker, it is definitely working for you. If you're a factory worker in the Rust Belt, though, can you say the same? And do you think countries have global obligations to each other? Do you think should American voters have to care about the fact that, globalization is helping great numbers of people be lifted out of poverty? Or should they just vote for their own interests? And is it voting for their own interests to curtail globalization?
Well, history would suggest that if you have a reversal of globalization, it often is associated with bad things. And it's not because people intend there to be bad things. It's rather that bad things come through as a consequence of changing, if you like, the rules of the game. And one thing we learned, I think, after the end of the Second World War was that it was far better for nation states to, in one sense, engage with each other, to agree on a common set of rules in terms of that engagement, and to recognize that by engaging, they were likely to become better off rather than worse off. And you think about the institutions that were created in Bretton Woods in 1944, so it's the IMF and the World Bank, and then the General Agreement on Tariffs and Trade, and the OECD and the EU, and all these things that eventually came out of the sort of post-war settlement.
Yeah.
They were all designed to say, look, we don't want a repeat of the isolationism and protectionism and nastiness of the interwar period from the 1920s through to the 1930s. We cannot possibly go back to that story. I think what is worrisome today is that for all the explanations as to why things have been more difficult in the West, the one that politicians have seized upon is precisely this issue of them and us, of suggesting that globalization is a bad thing rather than a good thing. And by focusing on the more tricky aspects of it, it has encouraged precisely this kind of narrative of them and us to emerge. Now, of course, once you have a them and us narrative, then you have to define who them are as opposed to us. And that raises all sorts of questions about citizenship, about nationality. It creates nationalist pressures of one sort or another. And again, we know from history that these things generally are bad things rather than good things. Yeah. So I'm not going to make a moral judgment about how American voters should vote. I'm simply pointing out that if that protectionist or isolationist narrative becomes more and more influential, then I think there are some historical lessons that we can learn from to tell us this may not be a good long-term outcome.
You mentioned the Bretton Woods Agreement there. The waning power of the US, which you also talked about in your book, and how that can, we can expect that to maybe undermine the IMF and the World Bank. Overall, these kind of global watchdog organisations like UED, they seem to have lost their teeth, in recent years. So, if countries can just flout rules, America does it all the time. Obviously, Trump's pulling out of climate change agreements. Can we truly have globalisation without regulation, without these kind of supranational organisations to regulate it?
Well, I think one answer there came from the global financial crisis, actually, which is that it was pretty clear with the growth of cross-border capital flows in the years before the global financial crisis that actually these organizations didn't really have the capacity, the ability to deal with these kinds of new forms of globalization. So we know already that if you haven't got these institutions functioning properly, then there's a danger that things go wrong. Now, prior to the global financial crisis, many people put their faith in the idea that markets themselves always work. But again, we learned from the crisis that markets can't really operate in a vacuum. There need to be rules of the game. There need to be institutions that govern how markets work. And basically, I think those institutions either weren't there or they failed to do their job properly in the years before the global financial crisis. What I think is now beginning to happen is a combination of things. First of all, as you quite correctly say, you've got the US in relative decline. And as it declines, it's beginning to wonder how far its global reach can really extend. It's a classic sort of declining empire or declining power type of story. At the same time, you've got other countries, notably China, which have gone from strength to strength economically, and if they continue to converge with the West, will become really a lot bigger relatively in the years ahead. And China is now in the game itself of trying to create institutions, which in one sense you could say are additions to, but possibly rivals to, the institutions that we saw in the late 20th century. So you've got the Regional Comprehensive Economic Partnership, which is a kind of trade arrangement for countries in Asia, led by the Chinese. You've got the Asian Infrastructure Investment Bank, which is like a World Bank, but to support Chinese interests in Asia, particularly associated with the so-called Belt and Road Initiative. You've got the Shanghai Cooperation Organization, which is a kind of Sino-Russian arrangement with involvement from Central Asian republics too. And so when we think about the declining institutions of the West, we've also got some rising institutions in the East, and they really do reflect, in my view, the relative success that China has had over the last few decades. So you begin to see not so much a kind of unipolar world dominated by the US as we've experienced over the last few decades, in which seemed to be almost the sort of default arrangement after the fall of the Berlin Wall. We've now got a kind of multipolar world of declining superpowers, emerging superpowers, all of which are trying to sort of shape the world to suit their own interests. And that, of course, creates potential tensions and possible conflicts in the years ahead.
Do you think... Okay, so we had the Cold War, we had America and Russia and their kind of client states and fighting a proxy through that. I will say, in defence of China, there's a lot of worry about China growing and becoming a military power. To be fair, though, it's never shown expansionist tendencies per se, besides these border territory disputes over islands and Taiwan. Do you think that a 21st century that is dominated by China will have China become a kind of military player, or, otherwise, as you said, try to be a very, very big influence on the world stage and influence, territory disputes?
Well, it's certainly true that China's never, at least recently, demonstrated the kind of the military or imperial ambitions that the West has been associated with. I think this is more an issue about accidental issues rather than intentional issues. So the bigger China becomes, the more investment it has to make in other parts of the world, whether it be in Asia, Africa, Latin America. It needs access to raw materials from other countries. It needs to have new trading partners to link up with. In those circumstances, it has to also think about ways of protecting its assets that it's created in those other parts of the world. And so when I say there's an accidental issue here, it's rather the idea that if China's invested heavily in parts of Africa, for example, and there is some political instability in those parts of Africa, which then leads to somehow those assets being, let's say, seized, then what does China then do? Does it simply say, shrug its shoulders and do nothing, or does it get involved in some way? And if it does get involved, does it get involved in a way that might sort of then trigger involvement from somebody else which has a different view? So it's these kind of accidental issues rather than intentional issues that I think are potential difficulty in the decades ahead.
Just a little bit, because obviously, you're very, very well grounded in economics. How much of a difference to the risk of a financial crash is separating commercial and retail banking? How much of a difference would that make? Is that, because there's a lot of talk saying that Glass-Steagall, that's where it all went wrong. I can't remember the British equivalent of that, but should that be a focus, or are people kind of off beam with that and focusing on that issue?
Well, I think it's fair to say that after the global financial crisis, there was a significant and fairly rapid shift in the political and regulatory framework. One of the shifts that took place was the idea that if you have global banks that have to be bailed out by local taxpayers, then it was important to shift the balance to protect the interests of local taxpayers in the future, as opposed to the interests of, say, the shareholders or bondholders of the global bank. And that's precisely what's happened, in the sense that we now have ring-fenced banks in, for example, the UK. You've got what you might describe as a kind of balkanization of regulatory framework. So international banks are facing different kinds of regulations in the US to those in Europe and so on and so forth. Again, each of these designed to protect the interests of local taxpayers. I think it's probably fair to say that banks as a whole are probably this could be famous last words, of course, but I think they're in a safer place than they were back in 2006 or 2007. But it is important to stress that each financial crisis has its roots in different things. To suggest that there'll be a precise repeat of, say, 2007, 2008 anytime soon, I think will be foolish. But to suggest that there will be the threat of some other kind of economic or financial upheaval, we can't rule that out at all. And one thing I would note, and this is actually a peculiarity of the post-crisis world, is that for all the attempts by central banks and so on to boost economic activity through zero interest rates and quantitative easing, what they've actually managed to do is to boost share prices and boost them a very, very long way. And in the US in particular, you now have a gap, I would say, between what you might describe as financial hope, as expressed in the stock market, and economic reality, which is nothing like as positive. And one big question there is, well, will that gap close at some point in the future? And could it close in a potentially financially uncomfortable way?
And can you just explain quantitative easing? As far as I can understand that it's, briefly, as much as you can, that, it's the government buying debt off companies so that they'll shift their money into the stock market to make it more valuable.
Well, the idea really is pretty simple, that once you get to zero interest rates, then conventional monetary policy in the form of interest rate cuts can't really go any further. So you have to have something else to try to boost economic activity, if that's what you want to try to achieve. And the idea with QE originally was that the central bank, so the Bank of England or the European Central Bank or the Federal Reserve, would basically go into the market and buy up second-hand government debt and other forms of debt. So effectively, if you're a pension fund and you own lots of, British government debt, the central bank comes along and says, we'll buy some of that debt from you. The consequence of that is that the price of those gilts or bonds goes up, the yield comes down, and that means in turn that the pension fund now has a lower yield, a lower return from the remaining assets.
So it's less attractive than to...
Less attractive, and therefore they then are persuaded to invest in riskier assets, like, for example, the stock market. And the hope was that if the stock market went up, then companies traditionally raise funds through the stock market, would raise more funds through the stock market, which they would then use for investment purposes. So the idea was that capital spending would then pick up, the economy would expand, productivity would pick up, and everything would be absolutely wonderful. Well, what actually happened was that the stock market effect did come through. There's no doubt the stock markets did rise, I think, as a consequence of quantitative easing.
Yeah.
But there's not much evidence to suggest that companies sort of celebrated by issuing more stock and investing a lot, because actually capital spending in the post-crisis world has been pretty weak. So this goes back to these issues about inequality, really, because if you happen to be the lucky owner of financial assets over the last few years, you've done very well because financial assets have risen a long way in value. But if you're hoping to see a big pickup in investment that would lead to faster growth and higher wages and so on, well, that hasn't really materialized.
I've heard that. Now, why do you think the companies are they seem to be hoarding their investment money for a rainy day? Like R&D is down, especially pharmaceutical companies not really investing there. Is it because they're expecting another crash on the horizon? Why has investment been so slow? Do you have any theories?
Well, I do, and it comes back actually to the sort of Japanese theme that, like in Japan, Western populations are aging. As they age, people's preferences, on average, begin to change. So let's imagine you're a baby boomer back in the 1980s. You're probably in your 30s or 40s. You're investing for the very long run because your pension's going to be paid out 20 or 30 years later. And you want your companies you're investing in to take long-term risks. So famously, Microsoft, for example, never ever paid a dividend. It simply reinvested all the profits back into the business. It expanded like crazy and, of course, kind of took over the world when it comes to office computers and software. Sure. Today, the same boomers, of course, are a lot older. They're either in retirement or they're approaching retirement. The long run for them, of course, is shorter than it was. And they want their investments to do something slightly different. Rather than looking for long-run return, they're looking for their investments to deliver cash up front, basically, a nice, steady trickle of cash each and every single year, because if you're retired and you haven't got a wage income anymore, you need to have something that's an alternative. So actually, the underlying investors themselves are putting pressure on companies to pay higher dividends, to offer share buybacks, and all the ways that you return money to the shareholder. Of course, for the company, that means that the pressure is there to earn profits up front, but not really to invest in the business for the very long term. So actually, one of the reasons it predates the global financial crisis, really, is the idea that aging populations not so interested in long-term investment. Long-term investment, therefore, doesn't materialize, and all that happens instead is that the cash is returned to the shareholder, which is good news for consumption in the short term. It's not good news for long-term investment or indeed for decent productivity gains. So I think that it's not so much that companies are fearful of the next terrible disaster just around the corner. I think it's much more to do with the fact that society itself has changed in terms of what it wants its companies to do.
Something you talk about in the book is called reshoring. So the idea that, now that robotics is going to play a much greater role in manufacturing, that companies who had previously offshored to China for cheaper labour costs, that they may well move back to the country of origin of the company, so United States and so on. Can you talk us through the implications of that?
Yeah, so if you go back to the last, 60, 70 years and think about one of the key globalization revolutions, it's all about the idea of global supply chains. The idea that rather than making a particular product in country A, the product would eventually be made in countries A, B, C, D, and E as a consequence of the creation of a global supply chain, and each of the countries would specialize in one particular part of the manufacturing process. And then eventually the consumer buys something which, is designed in California and assembled in China, which, of course, is the famous story of iPhones and so on. And that global supply chain story was based on the idea that, A, capital was much more mobile than it used to be, which is partly associated with the global communications revolution, and B, that labor costs in, say, China or Indonesia or wherever it might be was significantly lower than was true in, say, the US or in Europe. So capital would go to these places. They would begin to see decent economic growth, but they'd begin to also start producing things they weren't producing previously. And you have this kind of global supply chain story. One of the challenges with robotics is that it may be within just a handful of years, in fact, it's already happening in many cases, that you can make robots that are even cheaper than hiring the cheapest labor. You don't have to give them toilet breaks. You don't have to give them training. They can work 24 hours a day, et cetera, and the more and more tasks that can be done by robots, the bigger, in my view, is the threat to global supply chains. So you can reshore, you can bring the robots at home rather than investing abroad. It reduces some of the risks associated with global supply chains, because sometimes they can be quite fragile, as we discovered during the Fukushima nuclear disaster in Japan.
Yeah,
a few years back.
You mentioned there was a car park company that was right beside it and made 40% of some component.
It was these tiny little motors that operate virtually everything in cars, and suddenly the whole factory was destroyed as a consequence of the sort of nuclear meltdown and so on.
Sure, and obviously there's different property rights in different different countries that obviously have different laws, and going through
So what you end up with is actually incentive for companies to say, let's bring the products, bring the production process back home rather than leaving it abroad. Now, one of the potential difficulties with this is that, for Asia today, it may not be a big deal because Asia really already has developed in quite a big way, or at least some parts of Asia developed in a big way. But if you think about globalization as being almost like a queue of countries waiting to join the globalization story, and we've gone from, the Western world through to Japan, through to much of Asia. There's one part of the world in particular that is not really connected to the globalization story as well as it might be eventually, and that, of course, is Africa, and in particular some parts of sub-Saharan Africa. And the striking thing here is that that's the part of the world that's going to have by far the biggest increase in population size in the decades to come. And when I say by far, I mean these numbers are enormous over the years ahead. So this creates, I think, a big sort of global governance problem, which is that if globalization was a story about global supply chains and creating opportunity for more and more people, but robotics puts that whole thing into reverse and therefore reduces the opportunities for those people, then what do you do about all these people in Africa, where the numbers are going up dramatically in decades ahead, who may discover that no longer can they realistically be part of global supply chains? And the answer there is very simple. If the capital's not going to go to them, they're going to go to where the capital is. They're going to try and go in search for better opportunities elsewhere in the world. And so when we look at these terrible images of people desperately sailing across the Mediterranean to get to Europe, these, I think, are, in one sense, just a kind of relatively small dress rehearsal for the potential people movement that we might see in the decades to come.
Left-wing candidates like Sanders and Corbyn, they want to increase, we'll call it protectionism, while leaving immigration on the table. Is that a contradiction?
Well, it's not a thing, in a sense that I guess my sort of conclusion with regard to globalization is that if you try to stop it in one area, it kind of comes back to you in another area. So, for example, if you say, we're going to invest at home rather than abroad, well, there might be...
People will migrate to the job.
If you say that, as some people on the right have said, if you say we're going to have immigration controls, and by the way, we're not going to give any aid to countries abroad, well, that's in one sense almost a contradictory story, because if you don't give aid, the incentive for people to move will possibly be greater than what otherwise had been the case. So each way you have, in effect, forces that are beyond your control. And I think this is something which I think politicians, both the left and the right, haven't fully come to terms with, is that the more you sort of crave the safety and security and sanctity of the nation state, you're doing so because you recognize that a globalized world is a chaotic place in many ways. But in the attempt for everyone to sort of try to crave the security and sanctity of the nation state, it actually unleashes a series of other forces that may be difficult to control in coming decades.
Has globalization been good for Africa? There's a part in the book where you say, under US tutelage, many parts of the world experienced an economic transformation. So I presume you're talking about IMF, World Bank and so on. Africa has had its fair share of dictators who would often siphon off money that was given in aid or, other incentives. There was countries that ran up huge debts. I would contend that maybe it's more of a mixed story. So could you maybe talk about that a bit?
Yes, of course. Well, first of all, it's worth noting that if you look at the experiences of countries decade by decade, there's no doubt that some parts of Africa have had absolutely hideous experiences where living standards today or 15, 20 years ago are actually lower than they were back in the 1950s. And it's very difficult to find countries elsewhere in the world that have had that kind of appalling experience. The second thing I note is that, going back to this idea of a kind of a queue for globalization, it's certainly the case that many African states have been left behind in that queue for a variety of different reasons, even as others have joined in. So you think about Central and Eastern Europe and the gains that, for example, Poland has made over the last 30 or 40 years, a pretty extraordinary story. You think about the stories of China, more recently India, other parts of Asia, again, pretty extraordinary. But Africa, to the extent it has benefited recently, be more a story, I would say, primarily about commodities, and in particular the fact that Chinese demand for commodities has been very, very high, which of course has had spillover positive effects in terms of the value of African exports. Now, of course, you then got a separate issue, which is, well, who benefits from the rising commodity prices? Is it the whole nation state in a particular country in Africa, or is it the people who happen to own the commodities or the mines or whatever it might be? And of course, there is a series of differing views as to whether this is a good or a bad thing. But overall, the African experience of globalization has been, I think, a lot worse than most other parts of the world. You can trace this back to slavery, obviously. There's a chunk in the book where I talk about differing perspectives on globalization, and obviously the sub-Saharan African perspective is pretty bad for that particular reason alone. But you can also think about how Africa got caught up in the Cold War, with different African states being sponsored either by the Americans or the Soviets, ending up in many cases with large amounts of debt, which after the Cold War came to an end suddenly became much more difficult to sort of deal with and to digest, because of course both the US and the Soviets walked away from this and left these countries in a real mess. So at the moment, I think that there are still considerable difficulties out there, and one would have to hope that as a consequence of changes elsewhere in the world, Africa becomes more able to trade with other parts of the world. So rather than being dependent purely on aid alone, trade becomes increasingly a vital part of the story.
Sure.
And this is where I think the China story is important, because the Belt and Road story is not just about connections within Asia. It's also connections across the Indian Ocean into the east coast of Africa, and the potential for development in Africa to lift off more in the decades ahead.
How about the argument that agricultural producers in Europe, say bolstered by the EU, get subsidised, and they're now able to flood without the fact that there's no trade barriers means they're able to flood the African market with cheap produce, which then hinders the development of African agriculture producers?
Well, obviously the common agricultural policy has been criticised over the years for all sorts of reasons, and let's face it is a straightforwardly protectionist arrangement which looks after the interests of particularly smaller, less efficient producers in parts of Europe at the cost of producers elsewhere in the world. There's no doubt that is a controversial part of the story. But I think I'd also add that it's also the case that if you're relying on becoming rich through agriculture alone, it's not likely to work, in the same way that if you're relying on becoming rich through commodities alone, it's not likely to work. I mean, what Africa needs, and indeed other countries need, is the ability to diversify into a much wider range of economic interests. I mean, a classic example, of course, is Ireland itself, which was very heavily agricultural, and as it's diversified, it's become a whole lot richer. I think the idea of dealing with the agricultural thing alone, and that somehow being the answer for Africa, that isn't going to wash very long term. What you need is a kind of process of urbanization, the creation of new markets associated with urbanization, and indeed also the creation of new trading linkages with the rest of the world as a consequence of urbanization. It's those connections that really matter, rather than the idea that Africa should somehow do well only because of a change in European agriculture subsidies.
Okay, I'm enjoying myself too much. I'm going to have to try wrap up soon. So I'm just going to ask you 2 more questions, maybe 3.
Yeah.
First of all, Trump, he promises to bring manufacturing back to America. Is that possible? We're not in the future yet. Robotics is off in the future. 2017, is it possible?
Well, it's possible by bringing robots back, in the sense that might bring manufacturing activity back. But whether it brings jobs back is another matter altogether. Because if
can he slap tariffs on or chase? Say, listen, if any American company is going to have to start paying tax at American rates. It doesn't matter if you're in China or Ireland. Can he put pressure in that way?
Well, he can put pressure on companies. One thing he can do, of course, is to change the incentives in the US itself. So there's a lot of talk about either the administration or Congress cutting corporation taxes, which actually, funny enough, have ended up being quite high in the US compared with the kind of competitive reductions we've seen particularly in Europe over the last few years. So there are things he can do to create incentives to bring jobs back. But the bigger problem is this, that the idea that somehow manufacturing jobs have been stolen by the Chinese or by the Indonesians or whatever it might be, or the Mexicans in the case of the US. It may be partly true, but it's a very limited part of the overall story, because manufacturing in the West has been in decline in terms of a job provider for many, many decades. And it's not so much that it's because of globalization. It's more to do with the actual productivity of manufacturing, in the sense that you've seen this extraordinary increase in efficiency, which is partly associated with robots over the last few decades. So, for a given lump of manufacturing output, a given car, for example, the number of people involved in making it is so much lower than was the case 30 or 40 years ago. You go to a car factory these days and look around. Of course, it's all made by robots, and there's very little human involvement at all. So the problem is not really globalization. It's that there are just fewer manufacturing jobs than there were as a consequence of the automation we've already seen.
How come wages haven't risen with that increasing productivity?
Well, this comes back to the income and wealth inequality story, because I think it's probably fair to say that if you're the lucky owner of capital rather than the supplier of labour, you're the one that's generally done rather well over the last few decades. And again, there's something which is quite different from the past. If you go back, let's go back to the 1920s, for example, and the advent of mass production with the Model T Ford and all this kind of stuff. The companies that were created were what you might loosely describe as stakeholder companies. So obviously, the owner of the company and the shareholders did very well, but equally the companies employed vast amounts of people on a very sort of labour-intensive production line. And of course, many of those workers would end up buying the products that they were making, often through growth in consumer credit and so on.
That was his famous phrase, wasn't it? He wanted all of his workers to be able to afford the Model T.
That's right, yes. It was a kind of bootstrapping type of story, whereby the more you did of this, the more you'd sell, and everything was good for everyone. But then you look at the number of employees that, say, I don't know, Google, Apple, or even some of the more innovative apps that have come through, like WhatsApp. They employ very few people at all. So they have massive scalability in the sense that the products they make sell all over the world, but actually the number of people they need to make them is relatively limited. And therefore the profits they make will tend to go to, or the benefits of the profits they make will tend to go to the pockets of the few rather than the many. And so you end up with this sort of rather strange story whereby technology makes a limited number of people very rich, but it also changes the nature of the workplace. So the way in which the gig economy has arisen, 0 hours contracts, is itself partly a consequence of technology, because in the old days you would hire a worker for the year on, say, an annual contract or something. But now, of course, you can hire the worker by the task. You can contact them, say, come in today and do 3 hours, and come in tomorrow and do 5 hours. And that kind of stretchiness of labour supply is a direct result of technology. Now, it might mean that more people are being employed, but the number of hours they're working in many cases will be quite a lot lower than they perhaps had hoped for when they were going into the jobs market in the first place.
Final question. In your book, you say that, around World War II, 5% of global income was foreign held capital. And after the crisis, it's 200%. So do you think, is the world vulnerable to another financial crisis? Should we be worried about that figure? Or is that just, this is globalization, this is the way things are now, there's nothing to be scared about?
Well, I'm always worried about one thing or another. And, I would say that in this current situation, the worry is not so much the size of the ownership, but rather the sort of obligations and duties it imposes on different countries. So if you're, for example, a country that has built up lots of claims on another country by investing in that country, what is your role when things economically go wrong? So if we take the Eurozone as an example of this, there's no doubt that a lot of Germans invested very, very heavily in Greece in the years before the global financial crisis and indeed before Eurozone crisis. And it's Greece that's basically picking up the costs of all that because it's had to impose huge amounts of austerity. Its citizens have had to adjust in a dramatic fashion. But the German investors, for the most part, have been able to walk away without really too much pain. And I think there's a big question here as to, if you're the creditor rather than the debtor, what role do you have in promoting financial instability, and what role should you have in the event of financial instability leading to chaos in the country that you've lent to? Should you pick up some of the bill yourself? And my personal feeling is that the creditor country should pick up some of the bill. The difficulty, of course, lies in how you would impose that cost upon them in the years ahead.
Interesting note to end on. Okay, Stephen King, thanks very much for joining us. It's been fascinating.
Thank you very much indeed.
You're listening to the Political Book Show podcast.